Good.
9:31.
Yep. Good morning, y'all. Thanks for joining about how to buy down and rates and close more deals. I know today and this just so you know, if y'all have any questions, please feel free to raise your hand or put in chat box or just unmute yourself. Um, because I like to get feedback from you guys as well as if you have any questions that you need answered, I'd love to answer it. So right now we're in a market where it is technically right now, while I feel like a buyer's market. So if anybody feel like that's incorrect, let me know because I'm looking at the data in Atlanta. Right now, we have about 51%. Alan and I just did a backstory this morning on inventory, what's stale. We currently have about 51% inventory still that's currently stale. And of our inventory that's active, you'll see more days on market, and we have been inching up on those. So, what can we do to creatively help your client um, to win a deal? Right now I have agents they have a lot of creative way of doing certain things. So let's talk about what is a mortgage buy down. A mortgage buy down is the money pay up front to lower the interest rate. So if you have a client that really wants a house at a certain price point, but because today's interest rate and that they just don't have it, the beauty is that the seller can buy it down. So lower interest rate mean lower monthly payment. We all know that our buyer currently is buying a house based on the payment, not necessarily the value of the house. So the funds can come from buyer, seller, builder, or lender credit. So typically lender credit is hard to get just because lender don't have that much excess unless you're looking at a high-end purchase and there they may not always help you out a little bit, but 9 out of 10 it just depends on what a published rate is. Okay. So there's two type of buy down. One's a permanent buy down, which is low interest rate for the entire loan using discount points, and the other one is temporary buy down. You guys will see that a lot with new constructions. So even though if you're buying temporary buy down, the buyer still has to qualify at the end rate, meaning like right now, at one point, D.R. Horton was doing, I'm using them because they're probably one of the most aggressive builder out there. They were doing a 2-1 buy down where the first year was only 1.99, second year is 2.99, ending up 3.99. So you wonder how are they doing that? So so what they're doing is that the buyer has at the end of the day qualified for 3.99. Typically, D.R. Horton negotiate with the bank way in advance about millions of dollars that they're basically committed to buy. And in order to do that, they basically tell the bank, we're buying X amount of millions of dollars. Okay. We will guarantee the loans for this amount. And what can we get for rates? This is why you see, I haven't seen a 3.99 for a couple months now. Right now, they're all in about 4.99, if not 5.99 for some of the new constructions, even though that's still better than some of the interest rate out there, depending on the loan type. Okay. So builders go in buy bulk. And so when they price a home out, rather than discounting the home by $20,000, it's more palatable for them to just buy down the rates because when they price that home, they already got the buy down priced in with that purchase price. So a person that can typically in a regular mortgage lending institution can get right now FHA is running high six or low sixes. So if you go to a new construction and get a 4.99, that is a huge difference on monthly payment. Instead of being able to, let's say, afford a $300,000 home, you may get 375, close to 400, depending on what the builder has. So this is the power of buy down. Once again, a permanent buy down versus temporary permanent is that interest rate stay with you for the life of that loan. Temporary is typically a 2-1 buy down. Basically, the first year you get 2 points off, second year you get 1 point off, and the third year you're on the full rate. Okay. So, so temporary buy downs, rate reduced temporary during early in the mortgage, most common format, like I said, 2-1 buy down is often funded by seller or builder concessions. So payment gradually increase to the full no rate. So just so you know that if a borrower or a seller or a builder is doing temporary buy down, the buyers still have to qualify at the rate of the permanent rate. So the first 2 years basically relief and while they're moving and building up some asset. Um, and sometimes they know that, based on their pay scale, the path they're going, the next couple of years, they should get a pay raise. And so therefore, they felt like the 2-1 buy down is good for initially going in and buying a home. So let me just give you some example right here, 2-1 buy down. So if you went into a first year 4.5, 5.5, 6.5. So right now we're hovering about 6.5. Realistically, Penny, once again, your rate is based on your credit. The better credit you have, the better rate you have. So when you look at monthly payment at 4.5, this is based on a $450,000 home. You're looking at annual payment of $3,256. And so that's for the first year. The second year, be 3604. The third year, the final price will be 3971. So if you look at it, first year you'll save $8,580. Second year, save 4,400, and at the end of the cycle, you'll have your monthly payment on that. So this is the power of the points of interest rate. All right. Any questions? Anybody? Or am I going too fast? Okay, I'm assuming everybody got this. And once again, you can unmute yourself if you have any questions. So this is how the new construction is able to do what they're doing right now to entice agents. Not only that, they're giving incentives. So if you ever look at their disclosure to the buyer, if y'all take an opportunity to look at it, you'll see how much you're actually paying for these temporary debt buy down. I just did one with DR Horton, and their temporary buy down, just a temporary buy down, was around about almost for $415,000 purchase. The temporary buy down was almost $12,000. So rather decrease the sale price by 12,000, because what happened when they decrease that price of that home, the next property won't appraise, right? So it is to the builder's benefit when they can keep the pricing of the home in appraisal value, then lower the value of home versus the buy down, because they know either or way they gotta come up with that money, right? So it is easier for them to maintain the value of the home in the community versus um, taking a discount on it. I mean, back in, before the pandemic, so the new construction was basically reducing the sale price. So with the new thought pattern and what have you, the buy down is more attractive, and a permanent buy down is even more attractive for most your buyers, because they're basically able to buy a much bigger house or more value house for the same monthly payment. Okay. Let's talk about price reduction versus buy down and then what it impacts. So if you did $20,000 worth of price reduction versus a 2-1 buy down year one, this is how much you're saving a month. It's about $400. Okay. So while you are at a higher interest rate, you may get $20,000 off, but at the end of the day, if you're saving $400 a month, you do the math. That's it's going to take a little bit to calculate, but once again, I'm sorry, not calculate. Once again, at the end of the day, the buyer is buying based on the payment, not necessarily the price of the home. So if I can get $400 off a month, that's to me more value than it is the purchase price. So here's your payment impact example. Here's your normal payment around about 2100. With 1 year buy down, you're only paying about 17. And the second year you're paying 1900. And the third year you're paying 21. So you can see the same thing as the chart I did earlier, right here, where you see the savings of those buy downs. All right, what are discount points? Discount points allow you to lower interest rate in exchange for paying for an upfront fee. So investors, Fannie, Freddie, everybody else out there, conventional VA, you know, uh, FHA out there. So when you want to lower interest rate, they're saying that's fine. We're okay with it, but you're basically paying the interest rate up front. So let me explain to you about discount point. A lot of people get confused what discount point cost versus the actual interest rate. So 1 point of discount rate equals 1% of loan. So if you're doing a $400,000 loan, one discount point equals $4,000 that you're buying down. Okay, each point usually reduce the rates 0.5%. So 1 point equals 0.5%. So if you want to get a full interest rate from a, let's say 6.5 to 5.5, that is $16,000. Okay, a lot of people think that when we say 1 point, meaning 1% of the loan, which means 1% of the interest rate, that's not the case. It is only a quarter of an interest rate. So that's where some of the confusion are. So this is how we calculate as a lender discount points. Any questions? So it is kind of expensive to buy down, but if you look at the longevity of the discount points versus what are you saving, and I'll show you that next couple paragraphs as well. You'll see for the smart, educated buyers, they really love it. And at the end of the day, once again, they're buying based on the house payment versus the actual price point. All right, let's talk about discount points or prepay interest, basically. You're basically saying, I want to buy my points down, and therefore I want to go ahead and pay my interest up front. And so I have a much easier payment moving forward. Okay. So for each point costs about 1% of borrower. So with no buy down, your payment here is around about 25. When your permanent buy down, we're looking at almost $2,400. So there's a difference, and that's 1%, meaning at $400,000, I'm paying $4,000 up front, and my monthly saving is about $125 based on that particular scenario with that client's credit score. Okay. Any questions? No? Okay.
Thing.
All right. Yes.
Oh, I was just gonna say, could you go back to the slide before? Because I'm just a little bit confused.
It's
Because you
okay.
said 1%, and I
Okay.
thought
So one discount point equals 1% of the loan amount. Okay. So if you're buying at $400,000, one discount point is going to cost the seller or buyer $4,000 per point. And what it does, it only lower your interest rate by a quarter.
that's the part I keep getting that confused
Yeah.
about. That
Yeah.
1%, the
When,
quarter percent. Every time I just keep getting lost with it. So thank you
yeah.
for breaking it down again.
Yeah. So
Yeah,
1% discount
that's.
point. Go ahead.
Oh, I was just say that is great information you're giving me because not being a finance person, I didn't actually realize that about the points because I
Mm-hmm.
just never I don't buy into the whole interest rate thing so much. Like everybody else, the rates are just the biggest deal in the world to them. But it's interest rates are like a smokescreen for lenders and people, because if interest rate really made that big a difference in their budget and their business, why with less than a year after you get a mortgage, why does that same company reach out to you and offer you a lower interest rate to refinance?
I can answer that.
Yeah,
Okay.
because they
So the
make all
thing
their
is that
money
it's
up
okay.
front.
So as
Yeah.
the federal government lowered their interest rate, okay, so do we. So what happened is, as a mortgage banker, all these lenders out there, we knock on the door of the federal, and also what is being given. So, and I'm just gonna explain, and this is why I don't think some of y'all understand. During pandemic, the U.S. government on the Fannie Freddie and conventional, the investors, some of the investors, not all, were giving 0% interest rate for the mortgage banker to borrow money from them. Okay. When you have a zero as your basis, this is why you were able to see the 3.25%, 4% interest rate, because the mortgage bankers or the lenders are charging 3.25% or 4%, depending on your credit. Because, like real estate, mortgage lender has to make money. And this is where, kind of like us, we get a compensation, right? So the mortgage company has to make money as well. They're not here for nonprofit, they're here to make a business sense. So during the pandemic, when we were getting a loan as a mortgage banker for 0%, we were able to pass that saving to the borrower. So that is the difference. And now, after pandemic, that 0% interest loan are no longer available. And this is where the federal fund rates comes in place. When they say, okay, mortgage lenders, you guys are now being charged 3%, 2.5%, 3.25%. You see how that works? Because what happened is that there's a margin between what we borrow as a lender versus what the end user gets. Okay, there's got to be a margin, because there's no margin, then the mortgage lending institution cannot survive. And this is why when the federal fund say, let's say our base is 3.5, okay, from the federal funding, Fannie and Freddie Mac, and VA. So if they lower that to like a 2.5 or something like that, oh yeah, we're jumping all over to our past clients, say, hey, can we help you lower your interest rate? Because our points is still there to maintain that loan, to maintain that equity. And at the same time, that discount is being passed toward the buyer, because now we're able to borrow the same money for less and pass that saving back to the borrower. And this is why they are calling your borrower, your buyers, a year later, maybe 6 months later, when the rates are good. And at the end of the day, it doesn't hurt anybody to refi and save some money. If I can save $200 a month, if you look at it, that's $2,400 a year. And you can do some things with 2,400. That'd be a very nice vacation, Neil, going to Panama City. So,
Yeah, but if it costs you 5,000 or more to refinance, that's the point I was making. We helped one of Amy's cousins get into a very low priced home, like $160-something thousand loan.
right,
All right. And us helping, meaning helping by we put Amy on the loan with her, so that counts
right,
against us. So I said, you will pay us and I will pay the payment, because I want to make sure it gets paid.
right,
So the lender sends me a letter thinking, well, it's addressed to her, but I get the emails because I handle everything, I oversee it. And it appeared, oh, we're going to drop your interest rate 0.5%. And then I asked, so what are the terms? What are the costs to drop it 0.5%? And then he sent it to me and I recalculated and I said, okay, And of course, they said, no money out of pocket because we're going to put the refinance costs back into the loan. So
Correct.
I had to send him a stern email and I said, okay, so we're going to drop my interest rate by 0.5%, but it's going to cost me, the principal is going to be higher than it was when we originally closed a year ago. And my payment's going to go up because of that. And I just told
Your
him, I
payment
said,
should
I
never go up.
realize, well, in this case it did. And I
Okay.
said, because it's such a
That's
small loan. I mean, they owe 150 something thousand, but it was going to cost almost 4,000 to refinance. And so the original principal went up. And I was like, this may work. If you probably felt like you were dealing with someone that lives in a $150,000 home. However, I don't. I manage
so on
this
a
for
smaller
her.
loan.
Yeah.
Yeah, and I get it. If your monthly payment did not go down and you're incurring more principal, it's no brainer, right? So I would tell you, most mortgage lenders out there, when they do the math, they should have done that up front and not call anybody that may have a negative effect. Most of us, we know that's not sellable, but AI
Yeah.
technology, AI is like, here's a list of the borrowers that you had, hit them all. And it's a numbers game, right? And so the
Yeah.
one that's interested or the one that actually can save versus the one that cannot save. And for, like you said, not everybody look at it, but most of people can do simple math. If my payment right now is 2,000, you're telling me I refi, I'm gonna go 2,100? That doesn't make sense. That's definitely a no deal. But most of the time, most your lender has a algorithm they have in the back end. And so unfortunately, in your case, it sounds like that they just sent the basically your whole list of database without considering whether or not it was saving any money or not. But I wouldn't have a
Yeah.
conversation with a buyer if I can't save them money, period.
Yeah.
You're right. Usually, smaller loans, the cost for smaller loan is much higher because there's certain, just like operating a business, you guys have a certain basic cost in doing business, right? It doesn't matter if you have any income or have anything. It's so when you come in, you have your overhead. Same thing as lenders. These loans have certain overhead that is cost that is fixed. And as your loan amount goes higher, those fixed costs ratio wise is smaller versus a small loan. And that's why a lot of lender don't do small loan because it's such a high cost to do the loan that. And also, just so you know, in the mortgage industry, we can't do what we call high cost loan. We actually either, if we decide we want to proceed with this loan, we have to either reduce some type of costs in our back end or basically work for free, basically. And nobody's in the business to work for free. Um, and that's why, refi is a good business for some, not always all. So once again, sound like the person that just basically went ahead, threw all the database out there and not even look at whether or not there's any saving, which doesn't make sense because to me that's cost of time, resources. All right, let's talk about points. So resolve for $350,000 loan for a 30-year fix. Look at the scenario. So you got 6%, 5.5%, 5%, and 4%. So here's your monthly payment in the first column. See what interest rate does for you. I mean, that's almost a 400 and couple change difference in 2 points. Okay. Granted, it will cost you 2%, I'm sorry, 2% interest rate. It will cost you 8 points to get that monthly mortgage. But a lot of time, and this is the segment of this one, is that you guys know that you can ask seller to pay when you ask for seller concession. Not everything has to go in closing costs. Some of the concession can go into buying down the rates. So let's say if your borrower can only afford this monthly payment, If I can get seller to bring down, let's say currently they're qualified at this price point. All right, if I can get the seller buy down 4 points, which is equal 1%, then we can have a deal. Now, seller can buy unlimited points, whereas borrower can only buy X amount of points, even if they choose to have a lower interest rate. The thing is that in the mortgage industry, we cannot have what we call high cost loan. Okay, that is a negative. We just can't, and that was put in place to protect consumer, so consumer will not be taken advantage because some people will basically structure it to where it makes a very high cost for the borrower, and the borrower doesn't understand the whole logistic behind it. So this is what we talked about buying down rates, you guys. So if you have a buyer that is currently only qualified for this monthly mortgage, and the current rate is that 1987. So if we can get the seller buy down 2 basis points, meaning it's $7,000. Remember, 1% of this equals quarter. So we're getting 2 quarters, so we need $7,000 in order to get the buyer's rates down to this, which sometimes can qualify a buyer for that loan. Because in the mortgage world, it's about their debt to income ratio as well. So this is one way of you instead telling the seller, hey, let's reduce the price, because why don't we just buy down the buyer's rate? And instead offering to a very selective buyers that can only qualify at $1,900 a month, now we can offer it to buyers that qualify for $1,879. That makes sense, guys? Yes, no? Okay. Because I'm getting a lot of just silence. So I just want to make sure that I have explained it to where sometimes it's not about, and it's perception's reality, right? So sometimes you can convince your seller, yes, your house is worth every bit of $350,000. But in order for me to get more qualified buyer to buy your house, we may have to look at paying $7,000 for half a point in order to get some of these buyers to qualify for your purchase. And honestly, when you guys write a special step in your contract, you can put all party agree. Seller shall contribute whatever the X amount is. And it can be beyond just the points. It can be some of the closing costs, some of the buying down points. But what you can say is all party agree, the seller shall contribute, let's say let's do a round number, 500, a $500,000 loan. So we know conventional is only allowed 3, VA allows 4, and FHA allows 6. And we have a lot of right now FHA loan being processed because everybody's looking at low down payment. Now, with FHA, so 6 times 6 is, sorry, I'm trying to think, not 6. 6 times 5 is about $30,000 worth of concession you can ask. That's a lot of money, I know. But with that $30,000, you can buy down some serious rates. Okay, the seller technically, if you look at it, so 6% equals 1.5 interest rate if you're using the whole amount to buy down. Did I lose anybody? Okay, so you can buy down a lot of rates. I just see somebody in chat. Sorry. Okay, so you can buy down a whole lot of rates, and honestly, the buyer has the closing costs and the down payment. Okay, whatever it is, we can structure it based on monthly payment, and a good lender should be able to look at it and say, okay, this is how much money you have to work with. And the buyer has the down payment and some closing costs. So how can I maximize what you guys ask for seller pay and buying down the rest of it with points to help the buyer not instead of having a $1,900 payment, we have a $1,879. That makes sense. It's almost maybe $8 saving a month because a lot of people are buying, like I said, based on monthly payment, not necessarily the price. So the better interest rate, the better the borrower can afford a much more expensive home. So during pandemic, this is why people were able to afford a home that's $400,000 on a regular market with a regular interest. Their limit was only 300. So when you look at a home that's $400,000 versus $300,000, there's a huge difference. And that's why the inventory were flying off the shelf. Nobody cared about deferred maintenance because for them, it was cheaper to buy than it was to rent. So that's the reason why interest rate comes and plays such a powerful role in this scenario. So anybody have any questions? So if you look at it, 5.5% it'll cost you 7,000. That's your break even. So if you're not going to be in a house for more than 63 months, it doesn't make sense for a buyer to buy down. Okay. But at the same time, if I am only qualified at 5% versus 5.5, then that would be a very good tool. Okay. So if you're buying down a whole point, that's $14,000. You buy down 2 points, that's 28,000. So remember I told you guys the builders already did a permanent buy down, and that's because when they price out those homes, they already knew we're buying down 2 points or whatever points they're buying down, and this is how much it costs a builder, and they basically pad that number on top of what their reasonable margin is. Okay. And that's what makes the new construction very attractive for some of our buyer right now because the interest rate is great. Okay. All right, let's talk about some important risks to explain. Borrower must qualify at full interest rate. So just because a buy down shows that you pay much less every month, the buyer still have to qualify for the final rate. Okay. It takes better credit to utilize multiple benefits. So I know there's a lot of lender out there touts DPA, 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 DPA. Okay. I love that. The problem is that if you don't have the credit, you will not get DPA. And right now, the DPA programs are running about 660. Just because that they want to make sure the buyer has some skin in the game or has a good credit. So if you don't have good credit, guess what the buyer is going to be doing? They're going to put the full amount of the 3.5% in FHA versus having a DPA program available. Okay. So it is a little risky for y'all to publish that we can get you DPA when the borrower's credit is not so great. Now, as a lender, what we can do sometimes is look at their whole, so we pull their entire credit and we typically go for what we call middle score. And so if the middle score is, let's say, 635, the buyer has, okay, they already know they got to come up with 3.5% down, right? So if I can do at 3.5% say, hey, based on your credit, we can run an algorithm to see where we can get you up to 660 by paying off these debts, then you qualify for the down payment assistance. So sometimes it just depends on how the borrower wants to do this. And sometimes DPAs may not be the best program. And let me explain to you why. Anytime you ask anybody for any down payment assistance, your interest rate is going to be higher. Okay. Rather than say, let's say your baseline is at 6%. When you ask for DPA, typically the first loan, instead of being 6%, it may be a 6.25 or 650, depending on your credit score. And the second loan that you take out, the DPA, the 3.5%, is 2 points higher. So if you end up with 6.25 on the first one, your second one for the 3.5% down is going to charge you an interest rate of 8.25. So at the end of the day, the borrower can look at it and say, well, my monthly payment just went up. I'm better off just putting my 3.5% down and have a 6 interest rate for the entire life and just put that 3.5. So it depends on what each individual in motives. So we look at, as a lender, we do talk to them and ask them what is important, and we'll run scenarios and let the buyer make the informed decision. And so sometimes I know a lot of y'all want, hey, give me pre-qualified, which is fine. But those pre-qualification or pre-approval is good for that particular scenario. If the borrower at any time change that scenario during the course, understand that pre-approval may not be as solid because they're moving a different direction. Okay. So once again, payment increases when buy down ends for temporarily. Refinancing timing is uncertain. And once again, like Neil said earlier, that it didn't make sense, a phone call he got, where he's getting more principal and more monthly payment. It doesn't make sense. The only time we will make a call to the client would be, hey, can I save you $200 a month? Or normally, I don't even touch anything that's $100 or less. Actually, 200 is kind of my guideline because a lot of people think it's such a pain in the butt and I just don't want to deal with it. And $100 ain't gonna make me or break me. But $200, some people may look at that as incentive. And also the time you have left on the loan. Because if you have a longer term period in the loan versus a shorter term period, some people just say, no, you know what? That $300 is not attractive because my loan's paid off in the next 3 years versus getting a whole another whatever 30-year loan on this. So, but usually their principal balance is way less at that time. Um, so the question is, at what point should a seller consider offer rate buy down or closing cost assistance or both? If you've been on the market for a very long time and even though the seller is motivated, and let's say the comps hold, because that's the other thing y'all have to think about. If the property does not comp, it doesn't make sense to, even if you got a buyer that wants to buy it at $10,000 beyond the normal average, it doesn't make sense. But if you have a house that that is comped just right, but for some wonky reason, the house is not quite appealing because it's cut up or it's not open space or it has wallpapers and stuff like that that were just old, you might want to think about that. Okay. Once again, it's a seller decision. And as an agent, when you go and do a listing, if a seller says, I want at this price, and you look at the comp doesn't validate it. Okay. It doesn't make sense. So it's about time to market and whether or not your seller's motivated. Sometimes it's like going to Mark Spain for a quick sale, open door. There's cost and convenience. So if you are want to aggressively say, hey, after your conversation with the seller and the seller say, I really want to move this. I don't want to lose a whole lot. I know the house is worth $400,000. What can we do to quick sell it? This is one way you can do it. Or for a property that's been on the market for a very long time, your option is one, reduce the rate, sell price so you can attract more buyers. But a lot of buyers anymore are very well educated and they're wondering, well, the house has been on the market for 180 days. What's wrong with this house? Okay. And so, at that point, I do think price reduction is better versus buying down points. But, once again, you can try one or two marketing strategy when you do this and go from one, then move to the next one. Say, we can offer buy down rates. And when you do that, make sure you publish out your buy downs, and also and what you don't want to say, your rates is 6.5 or what have you. You just said seller will buy down rates, and each one of the rates will save you about a quarter point on the average. On the average, it's going to save you about $100 monthly payment. Okay, on the interest rate. So 1 point of the loan equals a 1/4% of interest rate, which on the average will save you about $100 on the average, $100 a month. So he can, so a borrower that is on teetering edge of, I only can afford $2,000 based on my debt to income ratio, and this house, based on the algorithm is around 2,100, then I have an opportunity to purchase this house. And at the end of the day, it's about buyer selection, that you are able to provide them with a value added items. Okay. But okay, great. Thank you. So let's talk about some strategy. Okay. Negotiating sell concession instead of price reduction. Because I don't know about any of you guys, but everybody loves seller concession because that's the less money the borrower has to bring. Okay. Utilizing closing costs to apply a buy down and use concession to fund a temporary buy down. Lower monthly payment helps buyer qualify, and buy downs reduce payments and improve affordability. Because right now, one of the biggest issues I see is affordability. So builder, if we're going to use that instead of price reduction, and as I explained before, they don't do it in price reduction because they don't want the rest of the neighborhood being comped out less as they progress. So you guys who understand financing, do really close more deal. And I'd love to partner up with you guys. If you ever want a conversation, sometimes buyers are, well, you guys know when you talk to a buyer, they tell you one thing, but they act differently. So for us, we are the nitty gritty on the mortgage side. We'll tell them, hey, this is what we're looking at. This is what we're realistically can afford. And sometimes it's about us helping them to restructure their score to where their interest rate is better. Okay. We always do what we call soft pull initially, so it does not affect the buyer's credit. And then based on that, we can see, okay, what's going on with your file. And then we'll have a very lengthy conversation with the buyer, say, what is your motivation? Just like when you guys go list a house, you got to find out from the seller whether or not they want to move quickly, they don't mind waiting. What is their target goal for pricing of their house? And also, of course, your compensation that you negotiate in. So all these has to be part of the equation when you talk to your client, just like we do when we talk to a buyer. So I hope that I have helped you guys and explain discount points. It isn't something that you guys need to know, but I do want you to know that this is why during pandemic things were flying out the shelf because people were able to afford a $400,000 home at a monthly payment around about 2,100. You can't get that today, and this is why some of the buyers are not willing to let go of their current interest rate. But one thing I do want to tell you guys, if you know a client that is struggling, okay, and what I mean by that is that sometimes I know your interest rate for a house is maybe 4%, but you got all right now, America is having the highest credit card debt out there. Okay. And now your credit card is around about 23, 26%. And your credit card is about 50 grand. Okay. That 50 grand actually may trump what you're saving in that 4% interest rate. We have had a lot of people come to us for debt consolidation, meaning their monthly mortgage, let's use an example, is $1,500. But their credit card is another $1,500 because of debt and they're not paying off a month. So when you consolidate those, it's $3,000 a month. We have had people refinance their house because at the end of the day, when you look at that 26% and that 4% and what the debt in there are, they actually will save around $500, $600 a month. Because when they consolidate their credit card and their house payment, they're only paying out about 2,500, 23, depending on what we're talking about. Okay. And now they're debt free. And the only thing we ask the borrower is don't get in debt again. Don't spend more than what you're able to pay for, because that is to help you to consolidate your debt, but you can't go on and incur any more debt beyond what you're able to pay off. So any question on that? So, and one thing that we want to reach out to our clients sometime and just to help them, because if they can see some relief on their monthly mortgage, guess what they're going to do? They're going to start saving. If they can save, maybe there is time for them to move again. And now they have the ability to save up some money and move and sell their house and hopefully recapture some of the equity that, has been built up over time. So I hope that you guys have learned about discount points and great. Okay, so do anybody have any questions? It's open discussion. And like I said, it's really not, and I know that sometimes you guys look at mortgage lenders like, you guys are so vague. You don't give me a concrete number and yada yada yada. That's because it's like having children in the same family. They all have the same last name, but each one and their personality is different. So for an FHA loan, sometimes the borrower have different needs and have a different desire, have different directions. Yes, ma'am. I will have those, email them out. And so you guys can have that. And if you want to have a copy of the slide, you can email, your branch manager. I'll make sure to get a copy of it as well. Anybody have any questions? It's been quiet group. I think you guys talked to Alan more. Okay. Well, if nobody has any questions, I really appreciate y'all attending. Hopefully I have educated you guys in learning about discount points and how it works and how it can be an affordability issue for some folks. And you guys, don't be afraid to ask seller for concession, because I think you'll find out how much the seller are now. If it's overpriced or priced to where it's not moving, how motivated they will at this point. And right now, we're actually in spring season. A lot of your seller may not be cooperative, but you just need that one that is cooperative to get you win the deal, right? So, because your buyer's only buying that one house, not multiple. So, but this is how you can negotiate and explain. And also, it really helps you guys when you call a seller's agent and explain to them the reason we're asking for 6% because we want to buy down some points so it's more affordable for the buyer, and also to where the buyer can qualify for this purchase. And at the end of the day, reassure them that your objective is close the deal. And I think that will help along the way quite a bit. All right. Nobody
Ming, I
have
just want
any questions?
Ming,
Yes,
I
go
Thank
have
you,
ahead.
just a
man.
different question.
Okay.
Oh,
Go for it,
Ming, I
Michelle.
just a long question. Um, Typically, when you do a hard pull, how much does it affect their credit score?
It's about 2 to 3 points.
And that's what okay. And that's what I thought, because that is it's just hard sometimes getting them to do it because they think they have this good credit and they don't want to mess it up. I'm like, you're not messing it up. That's silly. But
If they're a 680 credit score, that hard pull's not going to hurt them.
yeah, and that's what I
But
tell
I
them.
can do yeah, I can do a soft pull that kind of give me. So we normally pull TransUnion. TransUnion typically to be the middle of the credit score, 9 out of 10 between Equifax and gosh, what's the other one? Experian. Experian's probably the worst, just so you know. As far as credit score, anytime I pull any credit report, Experian's probably one of the lowest one. Equifax is actually the best one. TransUnion is always in the middle. So when we pull TransUnion, we're able to gauge what the borrower looks like. But there may
Okay.
be some time when you pull just TransUnion, because not all creditor reports to the same credit bureau. So if it's in TransUnion, it may not show up in Experian. So this is why when we do pre-approval letter, granted we have their we have their returns, we have their bank statement, we have their asset and also their W-2s, and we have verified their employment. If they're on the teetering edge, I will ask for permission to go ahead and pull a hard, just because I
And
know that we're just so close.
and how long typically does it take, just typical, to get if they turn everything in to get a approval from you guys?
It shouldn't take no more than 30 minutes, 45 minutes for us to run the algorithm, but a lot of time, I know you guys text me sometime. Yeah, I promise you it's not me, is that I'm waiting for documentation from them because without those documentation, I really, I really can't determine what that is because sometimes, and I'm sure you guys never experienced this before, but sometimes your borrower will tell you something and not being true. And so you're like, okay, I have one that left field. Um, oh yeah, I pull everything and it looks hunky dory, and then something else showed up in their credit report. I'm like, what is this? Oh yeah, yeah, that's supposed to be resolved. I said, until that gets resolved, I can't really do anything. You need to go ahead and make sure you communicate with the credit bureau with whatever documents you have and that should have dropped off. And then that's something I can help them out with as well because we do have a credit repair agency. And I know that everybody's looking for a cheap way route, but I'm telling you right now, for the borrower that really wants the loan, they'll work at it. For the one that doesn't want the loan or wants a cheap way out, 9 out of 10, they're not going to work at it. I'm just being realistic.
But my question was when you submit somebody and they turn in their documents, how many days can I usually take to hear from you? Just an estimate. Because sometimes I
Estimate
hate to
usually
say it, I
20.
got somebody, it's 2 weeks and poor dear ain't heard nothing.
Yeah, and typically, if y'all just text me and say, hey, listen, what's the status? I'll let you know if I'm looking for more documents or I'm not. Or I'll say, let me jump on it. Because the algorithm is not. Now, if you guys are texting me at 8 o'clock on Saturday night, I love y'all, but I might be out. So typically, the algorithm can be run fairly quickly. I would say probably within 30 minutes to an hour. And the reason I say that is because some people are a little more complicated in the back end, and we don't disclose what the complication is because, it's a privacy thing. That makes sense. So if you
It
guys
makes
ever text
sense,
me and say,
but so
hey, look,
basically, it doesn't take that long once they turn in all their documents. And really, that's what to
correct,
do is to encourage them to make sure that they follow those directions. Then it won't take that long to find
no,
out
no.
if they can get pre approved. Okay. Thank
Correct.
you.
So the thing we're looking at, typically, like I say, if I'm teaching, of course, that's 3 hours. But I also have an assistant. I actually got a really great a processor. She can run it like I do, and typically she can tell you pretty quickly. Um, but the thing we look for is bank statement, W-2s, and also bank statement W-2s, and we will verify their credit on our end. So those are three key components. And if they have any, now some people have divorce, alimony, maybe bankruptcy. We do case of those, but we have to double check the timeline. And also and just so you guys know, a lot of people are, at one point were getting a lot of student loans. And I don't know if y'all remember this, a long time ago, we were having, let's say if their student loans is $10,000. We have to account 1% in the past of that loan value, even though it may not be repayable immediately or deferred, we still have to count that into their debt to income ratio. Now it's only 0.5%. So instead of doing $1,000, it's $500, $10,000 loan that we have to account as $50. Sorry, $1,000. No, I didn't think about it. Sorry. But anyway, it's half what it used to be. So it allows a buyer to be a lot more qualified based on their debt to income ratio. So anybody else?
Mainly,
Amen.
thank you.
Yes, ma'am. Carla, go
I
for
would,
it. Oh, Georgia, I'm
Okay.
sorry. We're just talking.
Yeah,
okay. I
sorry.
wanted to, I know tax day is just a couple of days away.
Mm-hmm.
Would it be required for the buyer to have that 25 tax return done?
No, but we will ask for your W-2s. Okay. Now, if you're a 1099, that's a little more different. Understand when 1099 is a different program, we got to look at their P&Ls and it's a little more documentation. So, Michelle, back to your question, how quickly can we qualify? Once again, if you're a W-2 versus 1099, 1099 does take a little more time and a little more documents. Okay, but Georgia, no, you don't have to have a tax return. We validate. So as a lender, we do verification of income, and that is pulled nationwide based on payroll system, and it tells you truly what they're making versus what they claim to make. And also, you guys know that a person has to be working for minimum 2 years to qualify a loan. Now, what happens if you have a student that just graduated last year and they start working less than 6 months ago? Just so you know, as a student, the time they were a student qualifies them as, quote, working, okay? And so we would need a copy of the transcript to validate that they were as a student and they once they get out, they got a job and not 6 months, whatever time. I'm assuming the other year and a half as a student will account for that, even though they may make zero income. What we do is look at what their current pay stub is and average that out versus what a monthly income should be. So, Carla, you had a question?
Yes, thank you. I also want to say about the student loans. Before, I
Mm-hmm.
had a client that was there getting ready to get a loan, but the
Mm-hmm.
student loan was deferred. Then you have to pay attention to the government because they kicked that loan in 1 week before we closed, and my client could not close. And as of right now, I know they're in the process of trying to do away with some of the student loans, but everyone is not qualified. So you also have to keep
Mm-mm.
that in mind as well.
Yeah, and you're right. And as a lender, we normally just calculate 0.5% what the balance is as a part of their debt to income ratio. And depending on what loan they're getting, there's different debt ratios for each one of those loans. And while I know some of you guys are trying to get the phone call going by saying 580 credit score, 580 credit score, I appreciate that, but understand that that's going to be a longer road for most of them. You can definitely do a loan at 580, but the caveat on that is that you will put down minimum 10%, sometimes 20, depending on what your debt to income ratio is. So if you have borrower that has asset, has poor score, it's doable. It's just a little harder loan, but the government wants to make sure that you have some skin in the game at the end of the day. So you will have to have the down payment for that loan product. It's doable. So, and let me give you a prime example. A while back, probably about 3 or 4 years ago, I was talking to a lender and I'm like, wait. So this guy has great credit, but only claim probably $30,000 a year was going for a loan. he was approved because he was able to putting 30% down. That's because the way, and I'm like, that doesn't make sense. His rate was, even though he had good credit, his rate was higher because his income on a book shows that he doesn't make that much money, but his bank statement does. As a 1099, we like to write off everything. I get it. Okay. Um, but with that said, because they were able to put down 30%, that loan was approved because in their government point of view is that they're less risk. Because if the government had to sell this loan today, put the house back on the market, they will recoup their loan amount plus some. So at the end of the day, it's about risk assessment on individual. Everybody's different. So once again, 580 is fine. I even see a 520. But once again, it's like the DPA program. When you're asking for assistance or have some defects in whatever you do, money kind of cures it to a certain extent. So DPA, you got to have higher credit score. Low score, you got to put more down payment. So that's the algorithm by the government. So, and they just want to make sure they're, I mean, if you put yourself in their position, you will want to get your money back, right? So, and this is why in 2012, used to be FHA product, when you pay 75% of your loan, you can ask your PMI to be waived. Not anymore. It stays for the whole duration of the loan. And that's because during downturn market, we had hundreds of HUD homes. So they're trying to recover from all those debts. And that's one of the reasons why. Anybody have any other questions? And thank you for the point, Carla. You're right, because if that student deferment came online for whatever the reason is, then it can be calculated to the buyer's debt to income. And just so y'all know, as a lender, we verify employment the day of closing. So we have one case where borrower was good to go. Instead of closing Friday like she was scheduled, she decided she's going to take the weekend off. They were going to the beach or somewhere. Kind of Monday went to work and she was deferred. Now she's not qualified. So that one really hurts a little bit, but it happens. And nobody liked that because we all worked really hard to get to the finish line. Alicia, I saw you put your information there. Do you want me to send you a copy of the slide?
Yes.
Okay, cool. All right. Anybody else have any questions? Because it is interesting and why the builders are able to do what they're doing right now.
I would like a copy too, please, Ming.
Sure. Yep. All right. If nobody have any other question, I appreciate you coming down and learn financing, because this is not for everybody. But understand whatever we do, we will get whatever it is the best route for buyers. Sometimes the buyer has multiple paths that they can take. And sometimes they choose a path that's against logical thinking, but not every time the buyer will tell you everything is in their personal life. And for them, that's what they need to do. So once again, and honestly, you guys, and I told you guys this before, I came to the loan, I had my license for a long time, but I came to the loan is because I really got tired of age lender tell me that it's not qualified, not qualified, and not everybody works the same way. And for me, I really want to truly get you guys close more loan. And so that was my objective in coming here. And am I going to fail sometime? Absolutely, guys. I'm not going to say I'm perfect, but I can tell you I will work my hardest to make sure that we don't get to that point. And sometimes it's not you guys or anybody else. Sometimes it's just the borrower that have changed their mind or think this is too hard. And it happens. So anyways, okay, so I got Elwood I got your email. Alicia, I got yours. And Michelle, I got all three of y'all. And yes, KL, make sure you get yours too. But for most of you guys, you can just contact your branch manager and they'll be more than happy to give you a copy of the slide. Okay. All right. Thank y'all. I hope you guys have a great Monday and we'll talk soon. Take care.
Bye.
Bye.
Bye. Have fun, Neil.
Bye-bye.
I had to take you off of my phone and go on Amy's. I almost
It's
missed
okay.
an exit.
It's okay. Oh, don't do that.
Yeah.
All right. Take care, you guys. Okay.
All
Have
right.
fun, Florida. Bye-bye.
Thanks. Bye.
Uh-huh.